You were taught that banks lend out deposits. Someone deposits $1,000. The bank keeps 10%. It lends the rest. That loan becomes another deposit, then another loan, then another deposit. After enough rounds, $1,000 turns into $10,000. That is the textbook money multiplier. But there is a problem. In the United States, the reserve requirement is currently 0%. So if the textbook equation were the real engine of modern banking, the multiplier would be 1 divided by 0. Infinity. But banks do not create infinite money. The system does not explode. Credit is still limited. Lending still slows. Banks still fail. So the question is not whether the arithmetic is wrong. The arithmetic is fine. The question is whether the story has the causality backwards. Because in modern banking, the loan does not wait for the deposit. The loan creates the deposit. And once you see that, the entire financial system looks different. First, let us give the textbook model the best possible version of itself. Imagine a bank receives a $1,000 cash deposit. The reserve requirement is 10%. The bank keeps $100 in reserves and lends out $900. That borrower spends the $900. The seller deposits it at another bank. The second bank keeps $90 and lends out $810. Then the process repeats. The sequence is not random. It is a geometric series. 1,000 plus 900 plus 810 plus 729, and so on. The formula is clean. Total deposits equal initial deposit divided by the reserve ratio. If the reserve ratio is 10%, the theoretical multiplier is 10. $1,000 of base money supports $10,000 of deposits. The banking system creates $9,000 of loans. As a classroom model, this is elegant. It teaches that banks are not safe deposit boxes. It teaches that a small monetary base can support a larger deposit system. But as a description of how modern banks actually decide to lend, it quietly smuggles in the wrong first step. It says deposits create loans. The modern balance sheet says loans create deposits. Now, replace the story with a balance sheet. A business walks into a bank and is approved for a $100,000 loan. What happens at the moment of origination? The bank does not go into the vault, find someone else's $100,000, and hand it over. It creates 2 accounting entries. On the asset side of the bank's balance sheet, plus $100,000, a loan. This is an asset because the borrower now owes the bank future payments. On the liability side, plus $100,000, a new deposit in the borrower's account. This is a liability because the bank now owes the borrower spendable bank money. Assets rise by $100,000. Liabilities rise by $100,000. Bank equity does not change at the moment of origination in this clean example, before fees, provisions, or credit loss accounting. But the public's money balance has changed. The borrower can now spend $100,000 that did not exist as a bank deposit before the loan was booked. This is the key mechanism. A bank loan creates a bank asset and a matching bank liability. That matching liability is a deposit. And for the public, deposits are money, not central bank money, not physical cash, commercial bank money, the digital balances most people actually use every day. This is where many explanations become misleading. Because if we stop here, it sounds like banks can create money without limit. They cannot. The loan creates the deposit inside one bank, but money has to move through the system. Suppose the borrower uses the $100,000 to pay a supplier whose account is at another bank. The borrower's deposit at Bank A disappears. The supplier's deposit at Bank B appears. And to settle the payment, Bank A transfers $100,000 of reserves to Bank B through the central bank's payment system. Now Bank A still owns the loan asset, but it has lost the deposit liability and lost reserves. This is why deposits still matter. Not because a bank must first collect deposits before making a loan, but because after the loan money is spent, the bank must fund the asset it created. It needs reserves to settle payments, It needs stable deposits or wholesale funding to avoid a liquidity squeeze. It needs enough capital to absorb losses. It needs the loan to be profitable after funding costs. The old model says reserves are the raw material of lending. The modern model says reserves are the settlement asset of the banking system. That difference is everything. Now, run the engine in reverse. The borrower repays principal. If the borrower pays $20,000 of principal from a deposit account, the bank reduces the borrower's deposit by $20,000. At the same time, the bank reduces the loan asset by $20,000. Liability, down. Asset, down. The principal portion of the money is destroyed. This is the mirror image of loan creation. A new loan expands deposits. Principal repayment contracts deposits. Interest is different. Interest is a transfer of existing money to the bank as income. It is not destroyed in the same loan-canceling sense. The bank may later spend it back into the economy through wages, taxes, dividends, or expenses. But the principal repayment cancels the original loan asset against the deposit liability. This is why credit cycles matter so much. When new lending exceeds principal repayment, deposit money expands. When principal repayment exceeds new lending, deposit money contracts. Defaults and write-offs are different. They reduce bank assets and capital, and they can force tighter lending later, but they are not the same clean money destruction mechanism as principal repayment. The system is not a printing press with no off switch. It is a balance sheet engine that expands and contracts with credit. Now let us test the textbook model against the real system. The Federal Reserve Reserve Reduced Reserve Requirement Ratios to 0% effective March 26, 2020. That means the old formula. 1 divided by the reserve ratio no longer gives a meaningful cap. 1 divided by 0 is not a banking system. It is a sign that the model is being used outside its domain. The actual numbers are finite. In the Federal Reserve Reserve H8 release dated May 15, 2026, United States commercial banks held about $19.5 trillion in bank credit. Loans and leases were about $13.77 trillion. Deposits were about $19.22 trillion. The broader money aggregate M2 was about $22.69 trillion in March 2026. The monetary base, currency plus reserve balances, was about $5.46 trillion. A rough broad-to-base ratio is about 4.16, not 10, not infinity, not a fixed mechanical multiplier, and that is the point. The observed relationship between central bank money and broad money is not governed by one reserve ratio equation. It changes with interest rates, bank risk appetite, borrower demand, regulation, capital, and the structure of the financial system. The old formula gives you a clean classroom staircase. The real system is a credit network. So if reserves are not the simple mechanical constraint, what actually limits bank lending? There are 5 gates. Gate 1, capital. Every loan adds risk-weighted assets. A bank must hold capital against possible losses. For large United States banks, the Federal Reserve Reserve's capital framework includes a minimum common equity tier, one requirement of 4.5%, plus a stress capital buffer of at least 2.5%, and additional surcharges for the largest global banks. Gate 2, credit risk. A bank can create a deposit by making a loan, but it cannot create a good borrower. If default risk rises, expected losses rise, and lending becomes less attractive. Gate 3, funding and settlement liquidity. If loan proceeds leave the bank, reserves leave with them. A bank that grows assets without stable funding becomes fragile. Gate 4, profitability. A loan is not worth making just because it is legally possible. The spread between the loan rate and the bank's cost of funds must compensate for expected losses, operating costs, capital costs, and liquidity risk. Gate 5, borrower demand. Even if banks want to lend, someone must want to borrow at the offered rate. This is why modern money creation is endogenous. It begins inside the banking system, but it is disciplined by risk, capital, liquidity, regulation, and price. This also changes how we understand monetary policy. In the textbook story, the central bank changes the quantity of reserves, and the banking system multiplies those reserves into deposits. In the modern story, the central bank mostly changes the price of credit. Higher policy rates make funding more expensive. They raise the interest rate banks must offer to attract deposits. They raise the yield borrowers must pay. They can reduce borrower demand, reduce loan profitability, and increase default risk. Lower policy rates can do the opposite, but only if banks are willing to lend and borrowers are willing to borrow. This is why quantitative easing did not automatically create a proportional explosion in bank loans. QE can create reserves by purchasing assets. It can lower yields, support asset prices, and change portfolio incentives. But a reserve balance sitting at the central bank is not automatically transformed into a small business loan. A bank needs a borrower. It needs capital. It needs expected profitability. It needs credit quality. It needs funding stability. Monetary policy is powerful, but it is not a magic reserve-to-loan machine. There is one honest caveat. The textbook model is not useless. It can still teach that banks operate with fractional liquidity. It can still show why confidence matters. It can still explain how a system of bank deposits can be larger than the stock of physical cash. But it should not be taught as the literal operating mechanism of modern credit creation, because the sequence matters. If you think deposits create loans, you will imagine banking as a warehouse problem. First collect money, then allocate it. If you understand that loans create deposits, you see banking as a balance sheet and risk pricing problem. Create credit, fund it, settle it, regulate it, and survive the losses if you are wrong. That is the more accurate model, and it is more uncomfortable, because it means the money supply is not simply printed by the government or multiplied mechanically by banks. It is partly created by private credit decisions. Every mortgage, every business loan, every credit card draw. A private contract becomes public purchasing power. So the money multiplier myth is not that banks create money, they do. The myth is the order of operations. The old story says, deposits come in, reserves are held, loans go out, money multiplies. The modern system says, a credit-worthy loan is booked, a deposit is created, payments are settled with reserves, and the bank must fund and regulate the asset it has created. When loans are repaid, the principal money disappears. When credit expands faster than repayment, deposits grow. When credit contracts, money can contract with it. That is why banking is so powerful, and why it is so fragile. A bank is not merely a middleman between savers and borrowers. It is a licensed balance sheet institution that turns promises about the future into spendable money today. And the entire economy runs on the quality of those promises.